Walk me through a basic overview of gamma and liquidity levels and what information and value they're going to be providing to futures traders.
Yeah, absolutely. So I'm going to basically try and simplify as much as possible, and then we're going to go into some example. But going back to the delta hedging example, right? So when I'm buying an option as an investor, I am long options, while on the other side, the market maker is short option. And that brings us to the importance of the Greek gamma, right? So gamma is obviously one of the Greeks together with delta, and measures how much of an option delta will change if the underlying asset price change by 1%, and is key for delta hedging and the delta hedging activity of market makers. So the overall gamma exposure in the market can be positive or negative. And we calculate that by taking all the data from the option market and running our models. And why is this important? Because as we explained earlier, the market maker is constantly hedging its portfolio by buying or selling the underlying asset. But what they are hedging is really the change in delta. So how much delta changes as the price moves up and down. And this is why gamma is so important, because it defines the rate of change of delta. So the overall gamma exposure will affect how the market makers are hedging, and that will have consequences then on the price action, as you mentioned before. And this is why also future traders need to understand this, because this is very, very important. So let's simplify it again. So if we take all the data from the option market, we can calculate if we are in a positive or negative gamma environment. So let's start with positive gamma. Positive gamma means that the overall market exposure is long options, which means that there are more buyers of options than sellers. This brings us to how then the market maker is trying to hedge in a positive gamma environment. So the market maker buys when the underlying falls and sells when the underlying goes up. This is how they, cover their risk, and they stay delta hedged. So this activity is important because it tries to keep volatility low, and knowing how volatility will be before the market opens or during the session is very important clue for any trader, because remember, to be successful, you always need to be on the right side of volatility, whether you're trading directionally or whether you're buying option or selling option, etc. So that's very important. This brings us to the second concept, which is negative gamma, right? So on the other hand, in a negative gamma environment, the overall market exposure is short options, which means that more people are selling option than buying option. And this really affects how the market makers are hedging. So in negative gamma, the market maker is actually selling the underlying when the price falls and going long when the price goes up. So this mechanism creates more volatility. So this is where for example, we see those really big swings in the market, when we are in negative gamma. And this, again, is a very important clue for traders, because before the market opens, you're going to know if it's going to be a volatile day, what can be your price target, how should you play the day, and what strategy could actually work. And this brings us to then our gamma level indicator, which is really translating the complexity of the option market and adding those levels, those reaction zones into your chart. So we take that data, we create our quantitative models, and now you can leverage this data in TradingView with your favorite indicators so that you can overlay, an additional layer of protection. So you now know where the market will react, where to take profit, how to understand when there is a trend reversal or, a reversal trade opportunity, or when to stop out. So that's kind of like the goal of really this indicator, to define these reaction zones. And then we're going to also show you some examples on how you can use those. But again, this tool is designed for stock traders, futures traders, as well as option traders. But you don't necessarily need to actually understand how the option Greeks works to be able to use this indicator, which is the important part.